So let's start with this second chapter, which is on framework for financial reporting and preparation of financial statements. So we have to look at firstly the need for a common framework. Why do we need a common framework when we are talking about the financial reporting aspect? So one of the key objectives of accounting is to communicate the information about the organization to the stakeholders. So as I explained to you all last week, from the concept of looking at the shareholders, now we have moved into a concept called stakeholders. So we are primarily now looking at the larger audience, which is the stakeholders. So why do we need to do accounting is we make use of accounting to be the tool for our communication with these stakeholders. As you know, companies prepare the annual report or the annual financial statements or their interim financial statements, which are also published in the newspapers. Those are primarily the requirement to provide information to the shareholders. But as an organization, it is our responsibility to look after the entire stakeholders of the organization, even though the primary requirement to comply with the information being provided to the shareholder. Okay, so as a result, one of the objectives of accounting is to communicate the information about the organization to the stakeholders. And as a result, accounting is considered as a communication method. Now, you would have seen companies, in order to promote their products, they go out and put advertisements in the television, or maybe they broadcast an advertisement in the radio channels. That is a way of promoting your product. But it cannot be done in the same way for providing financial information. So that's why this accounting aspect is used as a communication method to talk to these stakeholders or the shareholders. So users, by using these information, the list of users we already went through last week, and I hope that you all recall those. There were about 7 categories of users, and what are the type of information that they look for. So these users make use of the accounting information, and what they do is they, based on these information, they make economic decisions. Very important, that is a key word here. They make economic decisions. So when you say economic decisions, their objective is where there is a monetary aspect is involved, and they are looking at a gain, or in other words, to attain a profit out of these transactions that they are willing to enter into in the future. So this accounting information that you provide is basically, as you know, is historical. What we do is, what we provide them is what has already happened. So the information or the transactions which we are dealing with in the next topic, we provide them the results of a transaction which has already happened. So in that sense, the financial information is basically an historical information, but it can provide details of maybe a forecast of what these companies are about to, for the decision maker to make use of such information to make economic decisions. Therefore, maintaining quality, reliability, and uniformity in these financial statements is very important. So, and as an organization or a company, it is our responsibility to ensure the financial information or the financial statements that we provide are of good quality, they are reliable, and you also need to maintain a uniformity, which is also very important. So let's move into the conceptual framework in accounting. The conceptual framework is a group of concepts that helps to prepare and present financial statements. So if we are to do any activity, there had to be certain steps followed or guidelines to be followed. Likewise, even in the case of preparing the financial statements, there has to be a set of rules or guidelines where you need to follow or where you need to adopt in preparing these financial statements. Now, these rules or guidelines are called concepts. There is a separate topic which we will deal with, the term concepts. So there are so many concepts that you may have to make use in preparing the financial statements. So even for your exams, some of these concepts may be tested either to define them or to explain the usefulness of these concepts, or maybe say, as you know, your paper will have a multiple choice question where it is the question number 2 mostly. In that you might get we are defining the concept and you might be given 4 answers. You need to choose the right answer for the concept. So these concepts is a separate topic which we will learn, maybe the 5th or 4th topic that we need to cover. In that we will go through the concepts that are being used in the process of preparing the financial statement. So it also helps to evaluate the accounting process, which is our next topic actually. The accounting process is the next topic that we are to cover. So the conceptual framework also provides, or in other words, evaluates the accounting process, whether these companies are following the accounting process as expected. The main objectives of the framework are where it explains the current accounting procedure and justifying the reasons for selecting same. So for example, let me take an example at this point in time. Now, as you know, every transaction have to be recorded. So there is no way that you can exclude any transaction that is happening in an organization. So that is your current procedure. That is your current accounting procedure. Likewise, there are various other procedures that you need to follow. So that as we go on, you will come to know all those. Then it also explains how future accounting procedures should be. So taking into consideration the changes that are happening in the accounting field, or maybe by whatever the new requirements that are coming up from the regulators or maybe the accounting bodies. So you should be able to, or in a position to take in all the inputs of those new regulations or directions into your accounting procedure in the future. So I may quote an example. As you know, like in 2018, with effect from 1/1/2018, Sri Lanka moved into the adoption of SLFRS 9, which is the new accounting standard then. So prior to that, we were adopting LKS 32 and 39, which is primarily used for financial instruments. There is a separate topic which we need to cover. These financial instruments were covered by LKS 32 and 39. So if you look at this, LKS 32 and 39 came into a halt as of 31st December 2017. So all the companies have to move into 2000 with effect from 1/1/2018 into the new standard, which is SLFRS 19. So SLFRS 9, sorry. So the companies were prepared to take up that challenge. So if you look at when you were in 2017 or 16, people knowing that they have to face this challenge, and that was a future accounting procedure for them. And thirdly, it explains the important terms in accounting standards and their limitation. Very importantly, in this particular module, as I told you at the inception, we may not go into details of these accounting standards. But if you look at every accounting standard is in very detail with regard to the adoption and their limitations and how it should be brought into the accounting procedure. So if you look at the accounting standard book per se, it's a huge book. So which is very cumbersome to read and understand sometimes, but for the purpose of knowing the main concepts of the standard, we will be covering certain standards in this particular module. So the framework also sets out certain assumptions. Now we already looked at what are the concepts. Now we are talking about something called assumptions. So in real life also we do certain things with certain assumptions. You know what is assumption is. Likewise, even in the field of financial accounting, we will do the same thing. There are few assumptions that we will make in the process of preparing the financial statements. So one such assumption is what is given below. And when we look at the concepts also, you will come across the same thing. So what does it mean? The first such assumption is the accrual basis. We call it as accrual basis. So what does it mean? The effects of transactions and other events are recognized when they occur. Please note that term. Events or the transactions and their effects are recognized when they occur, rather than when cash or its equivalent is received or paid. So what does it mean? That assumption of accrual basis means irrespective of whether you receive cash or you pay cash, because we assume that every transaction is complete when you either pay or receive money. But for accounting per se, it is not the case. In accounting, what we understand is the transaction, the point where the transaction occurs is the starting point for us to record this transaction. It is not at the point where you either pay cash or receive cash to complete the transaction. So this is what simply the term accrual basis means. You can call it a concept or you can call it as an assumption also. Secondly, the most important concept or assumption that is being used in the accounting field, which is called the going concern. So the financial statements presume that an entity will continue in operation indefinitely. I think I spoke about this last week also. We prepare financial statements assuming that this company will run indefinitely. Now, you shouldn't be preparing financial statements for a company which is going to be closed down in the next year. If you know that the company is going to be closed down next year, you have to say that in your financial statements. That we operate this year, we are presenting these financial statements, and we are sure that we are going to close down in the next year. So that the decision maker knows that this operation is going to end in the next year. Or maybe say in 2 years' time. But we never prepare financial statements taking into that sort of a consideration. So we always assume that the financial statements are prepared for companies which continue in operation indefinitely. Indefinitely means for an unknown future. For an unknown future. So I hope what we have gone through so far is clear to you all. Am I audible once again, and the screen is available to you all?
Yes, sir.
Right. So now we are going to look at some qualitative characteristics of financial statements. Qualitative characteristics, very important. So you know the financial statements talks about always quantitative things, that is numbers. But there are aspects which are not numbers, but some characteristics which are of qualitative nature. So we are going to look into those aspects. So the framework identifies certain qualitative characteristics. To be certain, there are about 4 elements that you need to look into. The first topic is, or the first characteristic is the reliability. What do you mean by reliability? Now, if we rely on a person, what do you call it as? You call it as you trust that person. So likewise, people who are reading or making use of your financial information should think that this information is reliable, because they are going to make a crucial decision based on the financial information that you are going to provide. So what do you mean by reliability is information given in the financial statements are treated as reliable when it is free from material errors. Very important term, free from material errors. So when it is free from material errors means you are sure that your financial statements are reliable. So as an accountant or a person who is involved in preparing these financial statements, there is something called ethics, accounting ethics. So when you follow these ethics and you follow the procedures, you mostly avoid any material errors. But there could be a situation where there could be certain errors unknowingly, but subsequently those need to be rectified. But in general, if your financial statements are free from any material errors, sorry, then we assume that those are very reliable financial statements. And also, the financial statement should not be biased. You know what is bias is? You prepare financial statements to favor somebody, or to you favor to some important factor that you consider as very important. No. Financial statements are prepared to a larger audience. As I told you, it is for the stakeholders. So you can't have a biasness in your financial statements. You can't be preparing your financial statements looking at the government only. No, because there are shareholders, which are the people who have given money to run the business. So we don't maintain any biasness among these stakeholders in preparing our financial statements. So the reliability is affected by the use of estimates and by uncertainties associated with the numbers in the financial statements. So estimate is again an assumption that you make in your financial statements. So the estimates have to be realistic. If you don't make realistic estimates, then again, it is going to dilute your financial statements. In other words, the reliability of your financial statements are lost. Now, what do you mean by estimate? Let me take this example at this point in time, which we will learn in detail. We will cover a topic called depreciation. So I think some of you might know what is depreciation is, but for the benefit of everyone, let me simply put it in a nutshell. Depreciation is where you have to account for the wear and tear of the assets that you are going to use in your business. Say, for example, you are going to use computers that are deployed in your business. You are going to use tables and chairs. So as a result of the usage, these assets are going to deplete over a period of time. Say, for example, you make use of a computer, that is a desktop. Now this desktop, how long can it last? In your guess, how long can a computer or a desktop can last without any problems if you are to use it? Can I have some answers, please? Why I'm not getting any answers? Can we have some answers? Yes, somebody say 5 to 6 years. Some people say 5 years. Yes, good. So now, some of you might have said 5 years, thinking that you might have used a computer for 5 years, or you might have heard of that, which is commonly understood. But in today's context, since we are all depending on IT, the usage of computers have gone beyond their limits. So basically, in my point of view, I would say the computers might last for 3 to 4 years if they are to be used in the way that are being used right now. So roughly, we may assume that a computer could be used maybe say 4 years or could be 5 years as you all suggested. So your depreciation for these computer assets will be limited to 4 years or 5 years. But if somebody goes and says, look, I will make use of my computer for 10 years, that is an unrealistic estimate. That is an unrealistic estimate. So when you make that estimate, unrealistic estimate, it is going to affect your financial statements. It is going to affect your financial statements. Okay. So you have to be very clear with the estimates that are being used in your financial reporting process or preparing financial statements. What are the estimates that you are going to use? And whether those estimates are realistic. If they are not realistic, then it is definitely going to affect your financial statements. So I hope that reliability, the term reliability is clear with you all now. Let's go to the topic of comparability. Comparability. So as you know, the users must be able to compare the financial statements of an entity through time in order to identify trends in its financial position and performance. And also there is an added feature which I will talk later. So what do you mean by this? Comparability. Now an organization prepare financial statement this year. And it is also known that you need to prepare your financial statements in the subsequent years also, because you are following the going concern principle. Going concern principle. So as a result, you are going to continue with your preparation of financial statement in the coming years also. So the decision makers or the users of these financial statements should be able to compare what you have produced last year with what you have produced this year. Because they need to know whether this company is heading towards in the right direction. If I am an investor and if I am to make an investment in this company, I need to know the performance of this company is in the right direction. So what happens here? I will take the financial statements of last year or maybe the 2-3 years back, and I will compare those financial statements with the others one-on-one every year. Sorry. So as a result, the financial statements that you prepare should be consistent across the financial years. You cannot prepare financial statements in a particular way in one particular year, and you can't change it altogether in another particular year. What happens? Then the financial statements cannot be compared. Cannot be compared. As we go on, you will see, or you would have seen already, in financial statement, generally, when you look at, say, for example, you have the annual reports of most of the companies which are having a financial year of December 31st, have produced their financial statements. So if you go and look at those, they would give the December 2019 figures. Along with that, you will have December 2018 numbers also. So what does it mean? A reader looking at your financial statements for the year 2019 will also know how you have performed in the year of 2018. So why do we provide this additional column relating to the previous year? That is for the reader to compare and understand the financial statements better. So now we have looked into two aspects. One is where your financial statements have to be reliable. And secondly, your financial statements have to be comparable. Okay. Sorry, I think I have skipped this slide. Sorry for that. I think this is slide number 5. Okay, so you're looking at accrual basis and going concern, and then actually there is understandability and relevance. After that, only these two. So let us go back to this and complete that also. So the next two criteria or the characteristics, qualitative characteristics are where your financial statement should be understandable. Now, say for example, if somebody comes and talks to you in a different language where you don't understand, you might not want to continue the dialogue with that particular person, because no point in continuing unless you understand what this other person says. The same thing applies with financial statements also. The information that you are trying to present in your financial statement should be readily understandable by the users who are using these financial statements. But you need to be mindful about not every person on the earth is going to look at your financial statements. But mostly we are trying to prepare the financial statements assuming that everybody look at it. But we also assume that the financial statements will be gone through by a person who has a reasonable knowledge of business and economic activities and also the accounting function. So not everyone will go through the financial statements with these criteria in mind. That is, they should have a reasonable knowledge about the business and the economic activities, and also the process of accounting, how financial statements are prepared. So our target audience for this matter is now confined into that particular group, where we assume that the financial statements should be understandable by people or the users who have a reasonable knowledge of business and economic activities and also about accounting. And lastly, we have the concept called relevance. We talk about a characteristic called relevance. So information in financial statement is relevant when it influences the economic decisions of the users. I spoke about what is economic decision is. So the financial statements become very important as long as it can influence the economic decisions of users. Relevance can help the economic decision makers to evaluate the past, the present, or future events relating to the entity. So here comes the importance of relevance. What does it mean? By looking at your financial statements, you understand how this company has performed in the past. And when you look at the current position, you understand how it is performing now. And then you make a judgment for yourself how this company could perform in the future. If you can fulfill these three qualities, that is called relevant. Your financial statements are relevant as far as the decision maker is concerned. If you can't fulfill that relevance, then no point in producing a financial statement, because the financial statements may not be understandable. As I told you previously, it cannot be very reliable also. It cannot be comparable also. So the 4 aspects that we looked at: understandable, relevance, reliable, and comparable, go hand in hand. Every financial statement should have these 4 qualities for a user to benefit out of the financial information that you provide. Any questions at this point in time? Okay, so there was a question where they requested to explain the accrual basis. So accrual basis is where, let me take an example. We start with the cutoff point of, let's say, January 1st. So you start running your business. As you know, the use of or the consumption of electricity is one simple example. So you start consuming your electricity for the month of January. But you know that the electricity bill for the month of January comes only in February. Okay? The electricity consumption that you do in the month of January, for which the bill will come in the subsequent month, in the month of February. So that is where you will see the consumption pertaining to the month of January. So what does it mean? For the electricity that you have consumed in the month of January, you will pay it only in February or maybe later than that. So it is definite that I cannot pay for the consumption of a particular period in advance because I don't know how much I will consume. But in accounting, what does it say? You need to account for this with your guess, assuming that you might consume this amount of electricity and this will be the cost of this electricity amount that I have consumed. So what does it mean? The transaction or the event already happens, that is consuming electricity. But the payment for same in cash will happen in the subsequent month or maybe in subsequent period. So what does accrual basis says is, you have to account for financial transactions or event on the basis of accrual and not on the basis of whether you have paid cash or received cash. Okay. So as we go on, you will understand what this accrual basis is in detail and how do we apply it in our business accounting. Okay. Right. So we come to the key elements of financial statements. That is, if you look at every financial organization, it uses certain elements in the financial statements. So in broadly, every reader who is looking at your financial statements looks at six important elements. That is what is shown in this particular table. So I have given the elements in the left side, and what it is useful for is shown on the right side. Okay. So the most important two elements in every organization is the amount of assets that you have and the amount of liabilities that you may have to deal with. So assets and the liabilities. So what does it mean? These two are represented by way of a report or a statement which is called the statement of financial position. In good old days, we call this as the balance sheet. And we still use the term balance sheet, as you know, but in your exams as well as in the current financial reporting framework, we don't use the term balance sheet to call any statement. The term that is used now is the statement of financial position. Okay. So this term is actually, we will come across later when we learn the accounting standard LKS 1, which talks about the presentation of financial statements. So right now you just assume that the term balance sheet is not used in the framework of accounting unless otherwise to explain something. But if you are presenting your financial statement, the name of the statement is statement of financial position. And what do we have here? Your assets and liabilities. And the second set of elements is where you have income and expenses in your business. You have income and expenses in your business. Now, what is this? You get 100 rupees of income and you incur an expense of 50 rupees. Now what is it? There is a surplus of 50. Now this surplus of 50 is what in layman terms we call it as my profit. My profit. So the result of income and expenses is the product of your profit or loss from the business. Now this we called in the good old days, again, like the balance sheet, we call it as the P&L statement or the P&L account. But now we no more use that term. Now the term that is used for the P&L is called the statement of comprehensive income. I'm not going to detail what is comprehensive income is, because when we go to that stage, we will look at what is comprehensive income means. So in summary, what you need to know is, what does this statement of comprehensive income talks about? It is about your P&L, or how much is your profit or how much is your loss. And the next element is called the equity. The equity. So equity means how much of capital that you have brought into this business to start up this business. And then using this capital, what are the other elements that you have created to boost this business? So we call them in total as equity. And when we go on, you will understand what are the equity elements of a business. So right now you understand that principally the capital that you have brought into your business, either by way of issuing shares or you start up your own business, it is shown as part of your equity of the business. And for that, we prepare a statement in financial reporting, which is called the statement of changes in equity. The statement of changes in equity. And the last element that most of the users look for is the cash flows. The cash flows. What do you mean by cash flows? You receive money to your business, you pay out money from your business. So there is a money flowing into the business, and in money flowing out of the business also. So which means money is coming in and money is going out of the business. We call these as inflows and outflows of cash. Inflows and outflows of cash. And the accounting term used for same is called the cash flows. The cash flows. So again, a reader is very keen to understand what is the level of cash flow this company has, which is reflected in the statement of cash flows. Statement of cash flows. Okay, so there are 6 elements, and you have 4 set of financial statements. 4 set of financial statements. Now comes the important message to you. Ultimately, the objective of this module is make you all to understand these 4 statements, how you prepare them and how you interpret them. Because when you go back to your respective organization after understanding this module, means you should be conversant enough to prepare a set of financial statements. That is, these 4 set of financial statements for any organization. And also, you need to interpret these 4 financial statements for any business proposal that is coming to you for evaluation. Say if you are to give a loan, you should be able to understand and interpret the elements of these financial statements to interpret and look at how this business is worth for you to make the decision to give whether the loan should be given or not. So let me give this message to you at this point in time. The objective, ultimate objective of this module will be to make you all understand what these financial statements are and how these could be prepared and how to interpret same. And most importantly, the first three financial statements, that is statement of financial position, statement of comprehensive income, and the statement of changes in equity. That is where your question number 1 in your paper. So if you look at your question paper, you can look at the past papers. Of course, the last exam was not held yet, but all papers prior to that, if you can go and look at it, you will have the question number 1, which says that the first question is to prepare these 3 financial statements. But the statement of cash flows is also important, and that can come as a separate question. So in some of the years it has been tested, in some of the years it was not. So the statement of cash flows is an optional question, may or may not come. But the first 3 financial statements is mandatory. That is what your question number 1 is, which is always a compulsory question. Okay, so are we clear up to now? Any questions? Right. So let's move on. So since we have understood the elements, now let us try to understand what these elements mean. Okay, so I have been using these terms, assets, liabilities, and so on, but let us understand, and from the point of view of a definition, how to define these elements. So what do you mean by assets? An asset is a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. So this might look like a theoretical definition where you have to write in your exam. Say, for example, there had been one or two occasions where you might have to write what or define what an asset is. So when they ask that question, this is what you have to write. An asset is a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. But what does it mean? Let's understand by way of an example. Now, as you know, what I call as an asset is anything that I own. Okay, as an individual, if I have a vehicle or a car, what does it mean? That car belongs to me. I am the owner of the car. So anything happens out of that car is the ultimate result of using that asset. Likewise, in a business, there are various types of assets which have come into the business as a result of a past event. Okay, and the outcome of that event is the future economic benefit that you may want to derive. Okay, so let's take a simple example from your respective organizations or the banks that you are working for. Now today, you know, all the banks in the country are running on a platform on an IT platform using computer systems. Just imagine how it would be if these computer systems are not there. I know that maybe if you go back 20-25 years back, the situation was where people were doing all these bookkeeping and every accounting aspects manually, recording it in them in a book. But today we heavily depend on these computer systems. So imagine if these computer systems are not there today, where you might have come across 1 or 2 days in your respective organization where you say there is no system today. So it doesn't mean that when there is no system, you don't work. No, you do certain activities at the back end and then you bring it into your system on the subsequent day when it is available. But just imagine you are not having the system in the future. Now, coming up, you don't have the system where we can't sustain. because now we heavily depend on these computer systems. Now this computer system is an asset to your business or to your bank. Why do you make use of this computer system? To arrive at the business transaction for your respective banks. And out of these business transaction, you look at some future economic benefit, So what does it mean? The asset that you are having in your business and using in your business are with a motive or with an expectation to have economic benefits in the future. So any item that you own in your business, which has come in as a result of a past event. What is this past event? You would have gone and purchased it. So as a result of this past event, you are having an asset now, and that asset is going to give you economic benefits in the future. Economic benefits means you will have monetary benefits in the future. So that is what assets are. Then we look at liabilities. Liabilities are an essential characteristic of a liability is that the entity has a present obligation. I have spoken about this even last week. Obligation. This obligation is called a liability. Now say you have a obligation to go to work unless you declare yourself that you're on leave today or maybe on a particular working day. So that's your liability. But the business concern has different kinds of liabilities that they may come across, which are again resulting from transactions or events. Now these obligations are to be met. You can't say that you can't meet these obligations when you are running a business concern, because the obligation may be legally enforceable. Because every transaction that you do are legally enforceable. Say for example, a customer comes into the bank and gives you money that is in cash to deposit, let's say 20,000. The moment you accept the deposit slip and take the money into your respective till, the money belongs to the bank, and you endorse that you have accepted money from this particular customer, and you become liable to pay this 20,000 back again to the customer whenever the customer requires it. What do we say by that? It becomes, or the transaction becomes, legally enforceable. So the customer can always demand for the money that was deposited with the bank. That is why we call the deposits are a liability to the bank, because I need to pay back to the customer at any point in time when the customer requires it. Because today the customers can take out their money on demand. They just come to the branch, produce a certificate of their FD certificate, and they can withdraw money. Or if they have money in their savings account, they can just bring their passbook and give you and withdraw the money. And always remember, in today's context, since we are going into a platform of digital platforms, people withdraw money or they can put in money from anywhere they are. And since ATMs are operating, money can be withdrawn at any point of time. So as a result, the liabilities for a bank is very essential, because those are legally enforceable. As a result, there could be a consequence of a binding contract or statutory requirement. Okay. So liability is actually an essential characteristic of a liability is that they have an obligation to comply with. Okay. So liabilities means an obligation as a result of past events again. So for a bank, The loans that you give becomes your asset. The deposits that you accept becomes a liability. So you can quote these two examples. Loans will be your assets. Your deposits will be your liabilities. Likewise, you will have so many other items which you can go through in your financial statements of your organization, and you will come across those important elements. Then we come into the element of which is called the expense. So the definition of expense is which it encompasses losses as well as those expenses that arise in the ordinary activities of the entity. So whenever there is an expense, you know that you have to pay for it. If you are paying something, means that is actually, it could be an asset or an expense. So we have to understand this distinction in future. But right now you assume that when you say expense is mostly where there is an outflow of cash. Now, what kind of outflows can be there in a business concern? Say, for example, you might pay for stationery. The stationery that are being used in the bank, for which you might have to pay. So as I told you earlier, you might pay at a later point of time, but it doesn't mean that it is an expense for you. So an expense means any expenditure that you incur or you pay cash to run your business in the ordinary course of day-to-day activities that you perform. So which may include distributions among owners, we'll come to that later, payments to suppliers, purchase of assets, all these are cash outflows. But what happens, where do we call it as an expense? We call it as an expense when you make a payment to a supplier or a vendor for a service where you might have or for any other that you may consume. Say, for example, electricity. So when you pay for electricity means it is an expense to you. When you pay for telephones, the telephone consumption that you have made, it is an expense. Likewise, stationery. When you make use of A4 papers, that is an expense. So there has to be a clear distinction between expense and an asset, which we will come across in later talks. Then we also have income. Definition of income is where both revenue and gains. Now we saw what is an expense is where there is a cash outflow, money going out. So income means where money comes into the business. You do a productive business today and money is coming in. So money can come in both ways. It can come for an income and it also can come for a liability. Let me explain. You accept money from a customer for a deposit, but you already know the deposit is a liability. So the money that you get from the customer is not always an income. It is not always an income. But now let's look at another example. You provide a service to the customer. Okay, you provide a service to the customer. Say, for example, you open an LC, which is called the letter of credit. In your trade finance department of your respective bank, they might open an LC for a person to bring down a vehicle of his own choice. Now, when this LC is opened and processed, you charge this customer a commission. I hope everybody knows the term commission, what it is. And in being bankers, you know what is commission is for a bank. So the commission that you derive from the customer is an income for you, where you need not pay back to the customer. But when you have a liability means, when you receive from a customer, it is always payable back to the customer. But when it is an income means, you only receive, you doesn't pay back again. So any income that you get from customers is called an income to your business, which is a cash inflow to the business. And I have given you some examples. Sale of assets, receiving debts, receipts from the owner. So these are three typical inflows to the business. But out of the three, the second one is the mostly the income part of the business. Receiving debts means where you would have given a loan to a customer and you request the customer to pay back the loan capital as well as an amount of interest for the loan that you have given. And we come to the most important part of this element, which is called the equity. So we say equity is the residual value of total assets and total liabilities. Equity is the residual value of total assets and total liabilities. So I would like to make use of the board, and I hope that you all are looking at the screen. So I hope the board is visible to you all. Right. Okay. So if you look at it, now we said a business has assets. Okay. Is it visible?
Yes, sir. Yes, sir.
Okay. And you also have liabilities. Okay. You also have liabilities. So these are the two pillars of your business. Now, what do we say by equity is equity is basically the outcome of this, which means the result of these two. Understand that? So that is why I have given the definition as equity is the residual value of assets minus liabilities. Assets minus liabilities. Very important equation as far as your accounting subject is concerned. So we say that equity is the residual value where asset minus liabilities has a value. Where this is greater than 0. Say for example, your assets are 100, liabilities are 60. So you have an answer of 40, which means that is your. Okay. So mostly it is expected that this equity is something which is positive. But there could be situations where it could turn out to negative also, where it could be less than 0 also. And how that happens, we will learn over a period of time when we go on to see how it can turn into a negative also. So are we clear on what is equity is? Equity is the difference between assets and liabilities. Instead of calling it as the difference, we say it is the residual value. Residual value. I hope it's clear to everybody. Okay. Right. So we are going back to the presentation. So can you see the presentation again? Is it visible? Sorry, I couldn't hear.
Yes, sir.
Right. Okay, fine. Because since it is the first time that I'm using the board, I wanted to make it very clear whether you can see both. Right. So going back to the presentation, you know now equity is the residual value of total assets and total liabilities. And now we come across a most important equation. That is, equity equals total assets minus total liabilities. Okay, right. So now, who brought this into the world? There is a slide which I talk about the father of accounting. I hope some of you might know Luca Pacioli, who is known to be the god of accounting or the father of accounting. And he's the one who wrote about accounting for the first time. So he has contributed a lot for the accounting field. And I have added this slide actually for your information. So it doesn't make any very importance to your exam per se, but just to make you aware about how this topic of accounting has come into the world. Okay, you can read through for yourself. So I don't need to go through in detail. And what this leads to is where we talk about the accounting equation. The accounting equation. So it is the resultant of what we saw now, where we said equity is equal to assets minus liability. Assets minus liability. And now we have the formula where using the same, we say assets equals liabilities plus equity. Liabilities plus equity. So which means when you take the liabilities to the other side of the equation, it becomes assets equal liabilities plus equity. This is known as the accounting equation. The accounting equation. Very important that you have to remember, because this is what is going to take you forward in the rest of this course. So people have to remember, you all have to remember this accounting equation, because this is going to help you a lot during our whole course that we are going to do in the next, maybe I don't know how long it will take, but in this particular course, you need to know this accounting equation, because the accounting equation is going to be the foundation for the concept that we are going to learn, which is called the double entry accounting. Double entry accounting, very important. So the accounting equation displays that all assets are either, we call it as financed by borrowing money or paying with the money of the company's shareholders. So you need to understand, this is, I have taken it from the Investopedia as a definition, but what does it say? A company's asset is actually equal to the money that you have borrowed, which is your liability. When the customer comes and gives you money in the form of deposit, means that is a borrowing. That is a borrowing from the customer. And also, you have also brought in money from your shareholders, which is your equity or the capital. So you understand that the assets of the company is basically given by two parties. One is the people who give you money in the form of liabilities, where they give you money and they want to take it back. And then there is another set of people who will give you money and they don't ask for it again. They give you money thinking that you will do a good business and give them a return. And this return is called dividends. We have already gone through that. So assets equals liability plus equity is known to be the accounting equation, and which is the fundamental for double entry accounting. Okay. Then the next slide is, of course, looking at few examples for assets, liabilities, and equity. So you may go through it. We don't have to go in detail because some of the terms we will come across and we will understand those as and when we come across. Right. So now we are going to look at another important equation where I want to go back to the board again. So now we know that the accounting equation is a known fact to us. Okay. So assets, let me use the term, the letter A to indicate assets. Liabilities plus equity. Okay. So you know assets, all the assets that belong to the business, and liabilities is all your obligations that you have. But now what is going to happen is this equity, we are going to look at in components. Now primarily we know this equity is made up of capital. Capital means the money that is given by shareholders, which you don't need to pay back them. Okay. Now what have you done with money given by the shareholder is you would have deployed it in the business, and while running the business you would have come across income and expenses. Income and expenses. So what happens? The capital that is being deployed in the business now is going to produce an income and also an expense. And also an expense. So you know income means money coming into the business where you receive cash. Expense is where money is going to go out. So we spoke about something called cash flow, and money coming in is cash inflow, money going out is cash outflow. So when money comes in, we consider that to be a positive part. But expense is something where cash is going out, so we consider that to be a cash outflow, which we consider as a negative. Okay. So you see, income is a plus, expense is a minus. So income is positive to the business, expense is negative to the business. But as I told you earlier, what is the result of income and expense? That is the profit or loss of the business. So a business can end up making a profit or loss, which is a result of the income or expense of the business, and this is derived out of the capital money that was given by the shareholders and also the liability. So now shareholders have given capital, you have made out of income and expenses, result is a profit. Let's assume you have made a profit. Now what is the next step? This profit has to be distributed to the shareholders. So what do we call that? We call that as a dividend. So dividend is again something that you pay back to your shareholder. So what will happen here? That is a cash outflow. So if it is a cash outflow, then it is a minus. Then it is a minus. So now you see the original equation of assets equals liabilities plus equity is now gone into this space where we say the equity is capital plus income minus expense minus dividend. Now we can rewrite the equation like this. Assets equal liabilities plus capital plus income minus expense minus dividend. So you might be wondering what I am writing all the alphabet letters. No, that is to indicate assets, liabilities, and now the equity component of the business is expanded to show the capital, the income, the expense, and the dividend. So you know this is equity. The same thing is again put in the presentation. I hope you can see the presentation now. Right, okay. So what I have written in the board is same as what you are seeing in the screen. So now this original equation of assets equals liability plus equity is now expanded to capture the contributed capital, revenues. Revenue is the term known for income. And then you have expenses. And then as I told you, you have dividends. So the component of capital or the equity is now getting expanded to contributed capital, revenue minus expense minus dividend is actually called the expanded accounting equation. Expanded accounting equation. So now we have gone through two things. One is the accounting equation where it says assets equals liabilities plus equity. And then now we have the expanded accounting equation where it will say assets equals liabilities plus capital plus revenue minus expense minus dividend. These two are very important equations that you have to remember, because it can come in the form of multiple choice questions or it can come in the form of essay type question where both will have to be used. So please do remember that you have to memorize, or whatever you may call it as, you have to remember these two equations, because there can be alternative terms used in these equations where you need to clearly understand how this is being used. And most importantly, you see out of the equity component, we said the revenue minus expense is your profit or loss. So suppose if you make a profit and you know there is a requirement for you to distribute part of it to your shareholders, so which is your dividends. And once you distribute the dividends, now you might have a figure again, that is a number again, that is your revenue minus expense minus dividends. And that amount is known as retained earnings for a business. Retained earnings for a business. So very importantly, retained earnings is the income minus expense minus dividends of the business concern. Okay. In other words, we can further simplify the equation. Asset equals liabilities plus capital plus retained earnings. You see? So that's why I said the importance of this equation is where you can simplify this equation or you can expand this equation. Whatever it is, you should be able to understand by looking at the elements or the components of the equation. So what do we understand by retained earnings is? Retained earnings is the income minus expenses minus dividends of the business. Now, why this retained earnings is important? You need to know. So when you go on with the business, you know that initially the capital has been contributed by the shareholders. But you can't always run the business with the capital that you have. That is why using the capital, you derive at income and you might have to incur expenses. So you get a profit. Now the profit that you earn cannot be given back to the shareholder in total always. That's why we don't distribute the entire profit of the business to the shareholder as dividends. We keep a portion, we retain a portion. That is called retained earnings. Now, what does this retained earnings do? That is being used for the future expansion of the business. Future expansion of the business. Very important. You need to know that the retained earnings are the component which are going to be used for future expansion of the business. So I hope since this being an online session, whenever I say these type of things, you are taking down as a note in your respective exercise books or whatever, because it might be difficult for me to dictate notes in this. So I hope that you are making notes by yourselves. Am I clear with that? Can I have a feedback, please?
Yes, sir.
Fine. So I hope you all are making notes. The retained profit is used for the purpose of expansion of the business in the future. Okay? Because you know you can't expand a business. Say for a bank, if you want to, okay, somebody is requesting a note. Okay, right, let's say. So let's try to take down the note. I hope everybody is with a piece of paper or maybe an exercise book. So let's make a note. Retained earnings of a business, retained earnings of a business is used for future expansion of the business. For future expansion of the business. Example, for a bank, the retained earnings will be used to expand the business. Such as putting up new branches, comma, purchase of new assets, comma, making new investments, etc. Okay. So I hope that is clear. So if you look at a bank, for a bank, what is expansion? Expansion is they might want to put up new branches. So you can't put up new branches using the money given by the depositors. Why? The depositors will always come back and ask their money. So in order to put up new branches, or maybe say you want to purchase new computer systems, fixed assets, whatever. So all those are part of your retained profits that are going to be used for this purpose. And also, sometimes when you have excess money, you can also go and invest in various types of investments. For that also, you need to make use of your retained earnings. Okay. And the last slide that we have is under this topic is where measurement of elements in the financial statement. That is, now we have looked at assets, liability, and so on. How these are going to be measured for financial statements. So let's see some of the values that we are that you are seeing in the screen. One is called the historical cost. The second one is the current cost. Third one is the realizable value, and the fourth one is called the present value. So what is the historical cost? Historical cost is, let's say you are now in 2020, and you know roughly, let's take, if you are using a notebook, that is a laptop in your business, what is the roughly estimated cost of a good laptop? Let's say 100,000. But that 100,000 is the current cost. You see, 100,000 is the current cost of the market. But if you had looked at the same laptop, maybe say in 10-15 years ago, where it was introduced to the market for the first time, what would have been the cost? Maybe 200,000, 250,000. If you had purchased a laptop at that time and still using it very wishlessly, I think that is going to be called as the historical cost. The money that you have paid to purchase an asset long time ago, which means that is going to act as your historical cost. The cash that you have paid to purchase an asset historically. But current cost is, as and when you are preparing the financial statement, what is the price that is in the market? Or in other words, the current cost means that is the market value of your asset. Realizable value is where if you decide to sell this asset or get rid of this asset, then the value that is going to be received by disposing this asset is called the realizable value. The realizable value. And lastly, the present value. You know, present value is if you have something to be received in the future. Let's say you are supposed to receive 1 million in 2 years' time. And what you mean by present value is you discount that 1 million that you are supposed to get in 2 years' time to today. So what is that 1 million is worth today compared to after 2 years? So I think that is, you know, present value is the time value of money. Time value of money. So getting 1 million after 2 years, what does it worth today? That is what present value is. So we don't need to go into detail because we will be covering these in the respective topics. What is historical cost? What is current cost? Realizable? All these things we will learn in detail as we go on. So that completes the second topic that we are supposed to cover. Any questions that you want to clarify? If not, we can go into the third topic. Okay. Okay, I hope the new presentation is visible to you all. Is it visible?
Yes, sir.
Right. Okay. So we are going into the chapter 3 since you didn't raise any questions on what we learned for chapter 2. Let me see whether I can have a full screen. Okay. So we are going into a new topic which is called the accounting process. So the accounting process, what does it mean? We start off with to understand what are the categories of accounting that are available. So to start with, our core subject, that is what we are doing, actually is known as financial accounting. So what we are going to learn is the topic of financial accounting, which provides historical financial information about the organization. But apart from that, in business concerns, there are accounting methods used for various purposes. For example, people make use of management accounting, which provides the information for internal planning, decision making, and controlling purposes. Bank hardly use management accounting because mostly they are to deal with financial accounting, which is relating to the historical information. But if you look at a manufacturing organization like Brandix, Mars, those type of companies, they heavily depend on management accounting because they want to know their internal planning, how it is going to be done or how it is to be done, because they deal with production, distribution, and working on the reorder level or reproduction level. So there are various aspects that they need to look at apart from their financial information. So you need to know, a company like Brandix might look at both management accounting as well as financial accounting. The management accounting will be used for their internal planning, decision making, and controlling purposes. But financial accounting is basically for them to produce their performance results to the outer world. In addition to that, there is another branch where we say that is cost accounting. Provides cost details of goods and services. So that is very the usage of cost accounting is really into a business where they are maintaining stocks or providing only services. That kind of a business might look at cost accounting. But basically, the most important two branches of accounting are financial accounting and management accounting. And you need to know what these two branches are doing. Financial accounting provides historical financial information of the organization, and management accounting provides the information that is required for internal planning and decision making. So why the accounting is important? Accounting is considered as a social phenomenon. What do you mean by that? Investors are keen to invest more and more in profitable ventures. So which means an investor who is looking at investing money, why he is interested in looking at investing money is because they want to know what are the profitable ventures or the profitable businesses. So they look at from one profitable business to another profitable business where they can put in their money to gain more. So the investor's perspective is to look after for the companies which are making profits. As a result, it is known to be a social phenomenon because people get information out of this accounting process to understand what are the profitable businesses. And secondly, it acts as a source of information. That is what we have been going through all these three lessons. That is, accounting helps to provide the important information not only to the third parties, but also to the management. So the slide before, you saw that the management accounting provides information for internal planning and decision making. Likewise, the financial information also, or the financial accounting information also, provides more details to the management for their decision making. And thirdly, it acts as a mean of control. Mean of control. What do you mean by that? It provides information relating to income, expenses, assets, and liabilities to the management to direct and control resources. Say, for example, in your respective bank, if the expenses are too high, the management will take immediate action to cut down these expenses. On the other side, if your bank's income is very low and there are found reasons for the income to be very low, the management immediately acts on taking actions how we could improve our income. So it is a measure where you can make use of to control your operations. When the expenses are high, you put in controls to minimize the costs. When the income is low, you put down controls and ways of means to improve your income. So accounting is also used as a mean of control for the management purposes. What do we say by the accounting process? So the accounting is at the mid of the business concern. What do? They take certain accounting input and it produces some accounting outputs. Now that is what we are learning or try to achieve out of this course also. To learn the accounting process. What is the input for the business? The transactions and events. Any transaction or event that takes place revolving around your business is the accounting input or the starting point for your accounting process. What is the ultimate objective? To produce financial statements. That is your accounting output. So the accounting process revolves around two important aspects. That is the accounting input to the process, and after processing it, what is the output that you give, which is the financial statements. Let's look at the transaction events. So we said that the input is transaction and events. Now let's look at what these transaction and events are. Business activities can be described in terms of transaction. That is both external and internal, and can be measured in monetary terms. So the transactions that you perform should be able to measure it in terms of money, both external and internal. And in addition to that, there could be events also, where those events are both internal and external. What do you mean by events here? Occurrences that may result in changes in value and quantity of assets, capital, and liabilities. So what happens here? You have two important aspects. One is a transaction, where a transaction can be measured in monetary terms. And secondly, the event, where there could be certain events or occurrences within the organization that can have an impact on the value or quantity of assets, capital, and liabilities. I'll give you two examples for describing these two, but let us look at the other points. External transactions are exchanges of value between two entities, which yield the changes in the accounting equation. Say, for example, external transaction is you do a transaction with one of your customers, where the customer comes and puts in money into his deposit account. What happens? When the customer gives you money, look at the point of view of the accounting equation. The money that you receive is what? Cash. So it is your asset. So your asset goes up or asset increases. On the other side, the money that you accept is what for your business? It's a liability for your business. Why? You need to pay back that to the customer at any point in time when the customer wants it. So basically, the external transaction that you perform results in two aspects. One is the money that you receive is an asset, because cash is an asset. And on the other side, you have to pay back this money to the customer when they want it. So it's a liability, your obligation. So if you look at the accounting equation, both your assets and liabilities will go up by the same amount. Will go up by the same amount. Similarly, internal transactions are exchanges within an entity. They can also affect the accounting equation. Say, for example, I purchase fixed assets. I purchase fixed assets for my business. I purchase a computer today. Now, what do I do? I bring in a computer to my business, which is an asset. But in order to buy that computer, what have I done? I have given out money. So again, I give out money means I am losing an asset. Now there is a balance. Why? You brought in an asset where assets went up by a certain amount. And in order to bring in that asset, you paid out money. So as a result, your money went down, which is your assets went down. So increase and the decrease happens in the accounting equation. And thirdly, the events. The events refer to happenings that affect an entity's accounting equation, which cannot be reliably measured. Now, this is where a tricky part of transaction or the event that happens within an organization. For example, let us assume that there is a fire which has occurred in one of the business premises of a business. Subsequent to the fire, you have to estimate the loss that you have incurred in your business. Now, estimating this loss is always a difficult task, because you don't know what was there and what was got damaged and what can be reused and what cannot be reused. So it's like a difficult task after assessing the impact of an event, which is the fire that occurred, and how to account for same, where the values cannot be reliably measured. So when it is a transaction, both internal and external, you know that there is a monetary value involved and you can do or account for that particular transaction. But when there is an event, the event may sometimes become very complex, where you might not be able to reliably measure. Please note that you may not be reliably measured. But what happens, businesses, they take certain assumptions and they measure it into their best of knowledge to account for same. So whether it is your transaction or event, both are accounted as far as the business is concerned. Okay? Are we clear up to that point? Any questions? Do you have any questions, please? Okay, so I hope it's clear with you all. Can we proceed? Do you all see the screen, the presentation? Right, okay, fine. Okay, let's proceed. So the next thing that we are going to look at is the accounting cycle. What do you mean by the accounting cycle of a business? So we start with the entity's operation, where you observe the entity's operations, what kind of operation that they are into. So in your case, if you are a banker, you know what type of transactions that happens. Basically, our primary objective in a bank is to do banking. Banking means you accept deposits, you give loans, and you recover those loans. So this is what we do as banking. But in today's context, apart from this primary business of doing banking, we have extended it to other more, what would I say, financial services that are being created by other service providers also. Say, for example, today the utility bills can be paid by through a bank. Earlier, if those were requirements where you need to pay to the utility service provider and pay directly to them. But today, we take care of that service as well. In addition to that, we provide so much of other financial services to customers. So you have to observe all these entities' operation in order to account for those transactions. Then from there, after observing the entity's operations, what you need to do is you need to identify the transactions and the events. Once you have identified the transactions and events, then you need to classify them into where you can easily record those transactions in your primary books. So this concept of primary books is a separate topic which we will cover, but you need to understand in today's context, with the use of computer systems, we are not looking at these primary books. In your day-to-day operations, in your respective banks, I don't know how many of you are even knowing where these transactions are getting recorded. So if you look at a set of manual bookkeeping, that is what we are learning, in a environment of manual bookkeeping, this is how it happens. The entity's operations are observed, transactions and events are being identified, then you classify them, then you record them in primary books. From the primary books, then you account for the transactions. Now, what happens in today, if you look at your bank, when a customer comes to your branch with money, that is the first step of observing the entity's operation. Now you need to identify the transaction, whether the customer wants to deposit money to his account or to some other customer's account, or whether this customer has come to pay a utility bill. So that is the where you will identify the transaction and then you classify them. So classifying means if it is a utility payment, you will put it under the category of utility payments. If it is a customer deposit, you take it as a customer deposit. Then what you do? You will account for the transaction. So if it is a customer deposit, you will take an option in the system and process it as a customer deposit. If it is a utility payment, you take a separate option for it and process it as a utility payment. So there is a clear difference between identification, classifying, and accounting for the transaction. Once the accounting for the transaction is done, we move into something called extracting the trial balance. Now, this extracting the trial balance is the starting point for financial statement preparation. So we will learn that in detail. What do you do with extracting the trial balance? Trial balance means where you go into your system or to your manual books, take look at all the transactions that you have performed and take a list of all the balances. Then when it comes to the financial statement preparation, prior to preparing the financial statement, you might need to do certain adjustments. So what you do, you go and do those adjustments to your trial balance that you have already extracted. Then you prepare your financial statements. Once you have prepared your financial statements, you will also want your financial statement to be looked at by a third person. Generally, this third person is known to be the auditor. So what do? We get the auditor to certify the financial statements that we have prepared. When the auditor goes through the financial statements, sometimes they might find out certain mistakes, errors that we have committed in preparing our financial statement. So then they will request the company or the organization to incorporate those adjustments. That is where we call it as posting closing adjustments. Once we have posted the closing adjustments and we are finalized with our financial statements, the next objective is to take those balances as the closing balances and proceed to the next financial year. So you need to understand the process of financial accounting is basically we cover up a particular period. This period is generally known as a financial year. The financial year generally covers a period of 12 months. And we will come across how these 12 months are looked at, all those when we learn the relevant topics. So in a nutshell, the accounting cycle means is the point where you start observing your transaction, identifying them, classifying them, recording them, accounting for the transaction, and then you extract a trial balance. You post adjustments to the trial balance, prepare the financial statement, get it audited, post the closing adjustments, and you take the balances to the next financial year. So in a nutshell, this is what is known as the accounting cycle. The accounting. So in order to perform the accounting cycle, there is a fundamental requirement which is known as the double entry system. The double entry system. So I spoke about the double entry system when we were looking at the accounting equation. The accounting equation. So the accounting equation is complied with when you are following the double entry system. If you follow the double entry system properly, that is where you comply with the accounting equation. So business transactions have two aspects. The business transactions have two aspects. Namely, we call them as a debit and a credit. So today we widely use these two terms, debit and credit. But how they have been originated is, it's a clear process that has gone through several phases, and now we have come to a level where we make use of the double entry system to record transactions. And how these transactions are recorded? By way of using debits and credits. So the following double entry system keeps the accounting equation in balance all the time. All the time. So I would like to go back to the board to explain how this works. So now we know this is your accounting equation. And now we are bringing in a concept called double entry system. And under this double entry system, we talk about two things. One is debits. The other one is credits. So using the debits and credits to account for the business transactions, we try to comply with the accounting equation. What do we mean by that? At the end of passing the relevant debits and credits, you always ensure that your assets are equal to liabilities plus equity. Okay, so all your business transactions are going to end up, that is, it is going to be an asset or liability or an equity, and it will be equal, where assets will be equal to the liabilities and equity, and this accounting equation has to be complied when you do the double entry system. Okay, so I would like to stop there today, since it is almost 10, and if there are any questions, I'm happy to answer them before we wind up. Any questions? Okay. Right. So we will continue with this topic next week. And meantime, I would like to see the possibility of hosting a question pack on what we learned under chapter 1 and 2, because I don't want to cover chapter 3. So considering chapter 1 and 2, I would like to put up a question pack, which I am planning to have it available by next Wednesday or Thursday. So you can have a look at the portal and see whether that is available. If that is available, try to do it by yourself. Try to do it by yourself at home, so that you can have an idea about how these two topics work. So if there is a difficulty, you can always raise it when we meet next time. So hope it was interesting to you all, and see you next week. There is a question where one person wanted my email address, so I'll just write it down. If you have any queries, you can always write to me. It's KAMALESH, Kamalesh, at combank.net. At combank.net. So you can make use of that email address if you want to post any questions. Okay, so let's that's done for the day, and I hope you will do a revision without waiting till the last moment. So as we go on, since you have time now, I hope you will start revising the work then and there when we do. Thank you.